Yes, April 2024, question number 3A. It reads, on 1st of January 2023, Tunza Limited had in issue 43.2 million ordinary shares of sh10 par value each, and 12 million 12% convertible redeemable preference shares of sh10 par value each. The preference shares are convertible into ordinary shares on the basis of 80 ordinary shares for each sh100 of the preference share capital. Tunza Limited profit after tax from continuing operation for the year which ended 31st of December 2023 amounted to sh201,600,000, and for the year which ended 31st of December 2022, it was sh97.2 million. The average market value per share during the year which ended 31st of December 2023 was sh20. So we're given some additional information about you're told on 1st of April 2023, the company invited the current ordinary shareholders to subscribe for a right issue on the basis of 2 new shares for every 3 shares held at consensual price of sh15 per share, when the market price on the CAMRIGHT basis was sh20 per share. Remember what we said is that anytime you come across a question for earnings per share, always the examiner will be testing this concept of the right issue. And actually, I think I explained the reason why this concept is always tested. We say the majority of the students are not able, number one, to compute the theoretical right price, and also to split those shares which were issued during the right issue into shares issued at full market price and into the shares issued free of charge. And actually, you're going to see this particular concept of right issue. We're going to deal with it the way we dealt with the other word. Question number 2, you're told on 1st of July 2023, Tunza Limited issued 36 million ordinary shares at their full market price. Number 3, on 1st of September 2023, the company made 1-for-3 bonus issue of ordinary shares using the share premium account. And number 4, we are told on 1st of October 2023, holders of shillings 80 million 12% convertible preference shares exercised their conversion rights. Now, what are we required as far as this question is concerned? Roman 1 is we calculate the basic earnings per share for the year which ended 31st of December 2023. Roman 2, we are required to calculate the restated earnings per share for the year which ended 31st of December 2022. And Roman 2, we are required to calculate the diluted earnings per share for the year which ended 31st of December 2023. So this was basically a very simple question from that topic of earnings per share. So we start with the Roman 1 of that question, whereby the examiner was requiring the candidates to compute the basic earnings per share for the year which ended 31st of December 2023. So the first thing you have to recall here is basically the formula for computing the basic earnings per share. And I hope you can remember from our previous session, we said to compute the basic earnings per share, we take the PATOS, the profit attributable to ordinary shareholders. We divide this with the one-offs, the weighted average number of ordinary shares. So therefore, we need to compute these 2 items. So let's start by computing the first one here. That is the PATOS, the profit attributable to ordinary shareholders. And actually, if you can be able to remember, you say to compute this, we take the company's profit after tax or the net income or the profit for the year. We less the preference dividend for that year. In case we are computing the basic earnings per share for a group of companies, we also have to deduct the profit attributable to NCI. So therefore, which information are we given to help us in computing this? Now, in paragraph 1, the last sentence, we are told Tunza Limited profit after tax from the continuing operation for the year which ended 31st of December 2023 amounted to 201.6 million. So what you're given there is the profit after tax. And actually, we are told that this profit from tax, or the profit after tax, is from the continuing operations. Is from the continuing operations, which is a figure of 201 600,000. I don't know whether I mentioned this in our previous class. Whenever the company is computing both the basic and the diluted earnings per share, the company should use the profit after tax, or basically the profit for the year, from the continuing operations only. From the continuing operations only. In other terms, in computing the basic and the diluted earnings per share, any profit for the, or basically any profit or loss from discontinued operations should be excluded. Should be excluded. So any profit or loss from discontinued operation should be excluded in the computation of these earnings per share. So what do you mean by discontinued operation? A discontinued operation is basically an operation of the company which has been discontinued. A good example of a discontinued operation is a branch which has been closed down. If the company had 3 branches and one of the branches has been making losses, as a result of that, it has been closed down, it is a discontinued operation. Equally, if, for instance, we have a parent company which had a number of subsidiaries, but one of the subsidiaries has already been sold by the parent company, is still a discontinued operation. So therefore, in computing both the basic and the diluted earnings per share, we use the profit from the continuing operations, meaning that any profit or loss from discontinued operation is always supposed to be excluded from the figure, or basically from the profit for the year you use in computing what? The basic and the diluted earnings per share. That is basically a very important point. And then now to this, what we do is that we less the preference dividends. We less the preference what? Dividends. Now, are we given any information about the preference dividends? Yes, we're given that information there. Still in paragraph 1, the first sentence. We're told on 1st January 2023 now, which is the start of the year, because I hope you can see this year was ending on 31st of December 2023, meaning that the year started on 1st of January 2023. We are told this company had initial 43.2 million ordinary shares of shillings 10 par value and 12% convertible redeemable preference shares. So this company had issued 12% convertible redeemable preference shares. There is also something you have to recall what we said in our previous class, that the company may have issued different types of preference shares. And basically, anytime you are told that the preference shares issued by the company are redeemable. This is very, very important. Redeemable preference shares basically means that these are those particular preference shares which the company is supposed to redeem them back, to buy them back by refunding the principal amount of money or the capital which was invested by the preference shareholders after a given period of time, if the holders of those preference shares will not convert them into ordinary shares. So in case the preference shares issued by the company are redeemable, because these are preference shares which the company has an obligation to buy them back, number one, to the company, redeemable preference shares is a non-current liability. This is just like a loan which the company has obtained from the bank. The company has an obligation to repay back that loan. Redeemable preference shares must be redeemed back after a given period of time, in terms of the company refunding back the capital which was invested by the holder of these shares. So therefore, one, these are non-current liabilities. Number two, the dividends payable in relation to redeemable preference shares. These dividends, they are classified as part of the finance cost. And actually, this is something you covered in financial reporting and analysis, specifically in that topic of the topic of published financial statement. So dividends on redeemable preference shares, they are part of the finance cost. And actually, what we know is that finance cost is an expense, or in other terms, this is one of the expense, which is usually deducted in arriving at this profit for the year, or this profit after tax. What does that mean, therefore? It means that if the preference shares issued by the company are redeemable, their dividends, we are saying, are part of the finance cost. And take into account finance cost is an expense, in arriving at the profit for the year or this profit after tax, that those dividends have already been deducted here as part of the finance cost. And therefore, in computing the PATOS, this one, we don't less a preference dividends relating to redeemable preference shares. The reason being, in arriving at this profit, they have already been deducted as part of the finance cost. I hope that point is clear. So anytime you come across a question for earnings per share and you are told the preference shares issued by the company are redeemable, never make a mistake of deducting those dividends here, because they have already been deducted in arriving at this profit as part of what? The finance costs. Are we together? Yes. I hope that point is clear. So therefore, in our case, those particular preference dividends will not be what? Will not be deducted. And then to this, we said we less the profit attributable to the non-controlling interest, But I think we say this one only applies to a group of companies. So if you check on the information which are given here, there is nowhere we are given profit attributable to NCI. And actually the information which are given here is for a single company, a company which is called Tunza. So basically we also don't have the profit attributable to who? To the NCI. So it basically means that the profit attributable to ordinary shareholders then remain the same. So this now will be our PATOS. This will be our PATOS, our profit attributable to the ordinary shareholder. So having that, then we need to proceed and we compute the one-off weighted average number of ordinary shares. We have to recall how we compute this. We say to compute this, we take the number of ordinary shares issued and fully paid at the start of the year. To that, then we add the other shares which the company issued during that year. So if we go back to the information we have in paragraph 1, we are told at the start of the year, that is on 1st of January 2023, we are given the shares, the number of ordinary shares which had been issued by this company. First paragraph, first sentence, we are told at the start of the year, Tunza Limited had in issue, in other terms, had issued 43.2 million ordinary shares. So the ordinary shares which had been issued at the start of the year were 43.2 million. So, and then now to this, we are going to add the other shares which were issued during the year 2023. And actually, the shares which were issued in the year 2023, we have that information, or we have those transactions under the additional information. Can we go to the additional information number 1? In additional information number 1, you're told on 1st of April 2023, 1st of April 2023, this company, we are told, invited the current ordinary shareholders to subscribe for a right issue. To subscribe for a right issue. Basically, this is something I insisted on very much, because I said that anytime you come across a question for earnings per share, usually the examiner will test the concept of what? The right issue. So therefore, what we said is that in a right issue, there are 2 things you need to do here. Or actually 3 things. Number 1, you have to determine how many shares were issued by the company during the right issue. And then from there, you proceed, you compute something called the theoretical exit price. And then finally, you split those shares into 2 components. The shares which were issued at full market price and the shares which were issued at nil consideration. So therefore, the first thing we need to do here is to compute how many shares were issued during the right issue, because we are not given that in note 1. We just told on 1st of April 2023, the company invited the current ordinary shareholders to subscribe for a right issue on the basis of what? On the basis of 2 new shares, on the basis of 2 shares for every 3 shares which were held. For every 3 shares which were held. So the first thing we need to do is basically to ask ourselves, how many shares were held before the right issue? You can't get that in the question. You can only get that here. So before this right issue was made, who can tell us how many shares were held by the shareholders of this company before the right issue? Before the right issue, how many shares were held by the shareholders of this company from what we have here? How many shares were held? How many shares were held here? How many shares were held here? How many shares were held? The shares which were held automatically are the shares which had been issued at the start. So therefore, the shares which were held before the right issue were 43.2 million. So what we need to do is we cross multiply, then we divide. So that now we can determine the shares issued during the right issue. So we have 2 times 43.2 million divided by 3, divided by 3, divided by 3, divided by 3. So this will give us what? We have 2 times 43.2 divided by 3, and this will give us 800,000 shares, 28,800,000 shares. So these are the shares which were issued by the company during the right issue. And then next, we also need to proceed and we compute the theoretical X-rate price. And before we compute this theoretical X-rate price, there is some information which we need to have here. Let's go back to our question. We see what we are told. We are told that in note 1, that the company invited the current shareholders to subscribe for right issue on the basis of 2 shares for every 3 shares which were held at concessionary price of 15. Basically, what that means is that during the right issue, the shares were to be issued at a price of 15 per share. And actually, we said this 15 shillings per share always is below the market price. A concessionary price of shillings 15 per share when the market price on the come-right basis. Come-right basis means that before the right issue was made, just before the right issue, the market price per share was 20. So these shares which were held before the right issue, they were trading at a price of 20. At a price of 20. That is the information which you need to have for we need to have for us to compute this theoretical X-rate price. And the same approach we used in our previous question is the same approach we are going to use here. I hope you can remember what we say. We say that to compute the theoretical X-rate price, here we say before the right issue, if as a shareholder of this company you held 3 shares before the right issue, you held 3 shares, and each share was trading at 20 bob, then during the right issue, you are to be issued with how many shares? 2 shares. Make sure you write that just below this. You are to be issued with 2 shares at a price of 15. At a price of 15. So it basically means that after the right issue, you'll be holding 5 shares, and these 5 shares will be having a market price of what? To get the market price of 5 shares, we take this times this, which will give us 60. This times this, which will give us what? 30. So mean that the market price of 5 shares after the right issue will be 90 bob. So how do we get the market price of 1 share after the right issue? We take the market price of 5 shares, divide that with 5, so that we get the market price of 1 share after the right issue. This will give us 1. And then we have 40 divided by 5. Will that give us 18 bob per share? Will that give us 18 shillings per share? 18 shillings per share? Yes. So that is basically now the market price, the expected market price per share after the right issue. Those are the 2 figures you need to have. The shares which were issued during the right issue and the theoretical X-rate what? Price. Now, having that, we come back here. So these particular shares which were issued during the right issue, we said we split them into 2 components. First of all, we determine the shares issued at full market price. How do we determine this? First of all, compute how much amount was received by the company from the right issue. So to determine the amount of money which the company received from the right issue, take the shares which were issued, which were 28.8. How much amount was to be paid per share during the right issue? A price of 15. Multiply that with 15. That will give you the amount the company received from the right what? Issue. Then divide that with the theoretical X-rate price, which is 18. And then wherever you get here, we say that because these shares are issued at full market price, we have to multiply them with the proportion of time they were held. They were held from April to December. How many months do we have there? From April to December, how many months do we have? Those should be 9 months. should be 9 months. Should be 9 what months, because we don't have the month of January, February, and March. The remaining months are 9. So multiply that with the proportion of time they were held. Then next, we determine the bonus element. The bonus element. These are the shares which were issued free of charge. So how do we compute this? We take the total shares which were issued by the company during the rights issue, 28.8 million, and then deduct the shares which were issued at full market price. And the shares issued at full market price is what we have here. Can you just transfer this here? We transfer this one here. 28.8 million times 15 divided by 18. And then we say these shares should not be weighted on time basis. We don't weight them on time basis. So let's get the final figures here. Starting with the shares issued at full market price, we have 28.8 times 15 divided by 18, which will give us 24 million. So this is 24 million here. And then we weight those shares on time basis times 9 divided by 12. So that will give us 18 million. 18 million. And then this will give us what? 28.8 minus 24 million. That will give us 4.8. 4.8, 28.8 minus 24. 4.8. Yes, I hope you're getting the same. So therefore, that is basically how we deal with the right issue. That's how we did with the right issue. We said you should not have any problem with that, because if you go through all the past papers, you'll be able to see that almost all questions for earnings per share, the examiner always tests this concept of what? The right issue. Hope you can see the question we did, this question and most of the questions. So I think we are done with that right issue. Let's move to transaction number 2. Transaction number 2, and we are told on 1st of July 2023, Tunza Limited issued 36 million ordinary shares at full market price. That is quite simple. We come here and we say on 1st of July 2023, we say there was issue at full market price. There was issue at full market price. Now, the shares which are issued at full market price, this one is quite simple, because what we just need to do is we multiply them with the proportion of time they were held during that year. We weight them on time basis. From July to December, automatically here we have 6 months out of 12. We have 6 months. So we divide that with 12. So this is like a half. So, and that will give us what? That will give us 18 million. So therefore, the shares which issued at full market price, no complication as far as that is concerned. You just need to weigh those shares on time basis. So we are done with that. Let's move to the other point number 3. Transaction number 3. We are told on 1st September 2023, the company made 1-for-3 bonus issue of ordinary shares using the share premium. Bonus issue, we know that this entails issuing shares free of charge to the existing shareholders of the company. To the existing shareholders of the company. Once the company make a bonus issue, the company will have to use one of the reserve to finance the shares issued free of charge. Like in that case, we are told the company utilized the share premium. So therefore, here we come and we say on 1st of September 2023, the company made a bonus issue. Made a bonus what? Issue. You can see specifically you're not told how many shares which were issued. We are told the company made 1-for-3 bonus issue. What does that mean? 1-for-3, because the first thing is to interpret the meaning of that. Bonus issue, 1-for-3. 1-for-3 means that during the bonus issue, the company was to issue 1 share for 3 shares which were held. For 3 shares which were held. So therefore, what we need to do here is basically to determine how many shares were held before the bonus issue was made. How many shares were held before the bonus issue was made? That is something you can't get in the question. You can't get that information in the question. You can only get it from what we have here. What we have here. So this is where you can get the shares which were issued or which were held as per this date. Now, how do you compute that? You come here and at the end of the year, you determine how many shares were issued at the start of the year. They are these one, 43.2. These are the shares which had been issued at the start. For how many were they? 43.2. Then here, how many shares were issued in this transaction? In this transaction, we know there was a right issue. So you take the actual shares which were issued here, not these shares which have been split into two. So can someone tell me here how many shares were issued during the right issue? The actual shares issued during the right issue. How many were they? Here. How many shares were issued during the right issue? The actual number of shares issued during the right issue. The actual shares which were issued during the right issue were 28.8. That's now what you add to these shares which were issued at the start of the year, 28.8. And then here, you don't take 18, you equally take the actual. How many shares were issued on this date? The actual on 1st July 2023. The actual shares issued here were how many? How many actual shares were issued here? Because they are not 18. They are not 18. How many? They were 36. Take the actual. So plus 36. Plus 36. So basically what that means is that on this date then, I'm getting the total shares which had been held or which had been issued by this company as 108 million. 108 million. So that's basically how you determine that. You come back here, you check on the shares issued, but you take the actual shares because majority of these shares have been weighted on time basis. Take the actual shares. So what we need to do is basically to cross multiply and divide because we are told during the bonus issue, the company was to issue 1 share for every 3 shares which were held. Cross multiply, then we divide. 1 times 108 million divided by 3. In fact, we can have that working here. 1 times 108 million divided by 3. And also you have to remember that those shares, we don't pay them on time basis. Shares issued at free of charge, we don't pay them on time basis. We just take 108 divided by 3. Divided by 3. Which will give us 36 million. 36 million. So that's how we determine the bonus issue. Don't multiply those shares. Don't weigh those shares on time basis. Then finally, in note number 4, we are told on 1st of October 2023, we are told that holders of shillings 80 million 12% convertible preference shares exercised their conversion rights. So what does exercising their conversion rights means? It means that the holders of shillings 80 million 12% convertible preference shares converted them into ordinary shares. So in this case, what we need to do is to determine how many shares, how many ordinary shares are issued on conversion. So here we come and we say that there was conversion of 12% convertible preference shares. So here we need to determine how many ordinary shares were issued on conversion. For us to do that, the first thing we need to have is the rate of conversion, the rate at which these convertible preference shares should be converted into ordinary shares. And that conversion rate, if you can recall, we have it in paragraph 1 of that question. Paragraph 1. Paragraph 1, let's go to sentence number 2. We are told the preference shares are convertible into ordinary shares on the basis of 80 ordinary shares. That's what we need to have, 80 ordinary shares. Ordinary shares of shillings 100 each. Okay. So on the basis of 80 ordinary shares for each shillings 100 preference share capital. So the company on conversion is supposed to issue 80 ordinary shares for every shillings 100 of the preference share capital. Preference share capital. That's what we are told. Now, having that information, we go back to paragraph 4, sorry, to note number 4. To note number 4, where we are told on 1st of October 2023, shillings 80 million of 12% convertible preference shares are exercised their conversion right. So basically what that means is that on this date, the preference shares which were converted into ordinary shares, they had a value of 80 million. So what we need to determine here, how many ordinary shares were issued on conversion? So we just cross multiply, then we divide. So here we take 80 divided by shillings 80 million divided by 80 million, 80 million divided by, we multiply 80 times 80 million divided by 100. So basically this will give us the ordinary shares which were issued on conversion. If you can recall, equally what we said is that those ordinary shares which are issued on conversion of convertible securities, we weigh them on time basis. So this one, we are going to multiply them with the proportion of time they were held. They were held in October, November, and December. These ordinary shares which were issued on conversion, they were held for how many months? For 3 months. For 3 months. So can we work out that? That will give us 80 million, or 80 divided by 80 million. That is times 80 million divided by 100 times 3 divided by 12 times 3 divided by 12. And I'm getting 16 million. I'm getting 16 million. I'm getting 60. I'm getting what? 16 million. 16 million. So just confirm whether you're getting that. Confirm whether you're getting 16 million. You're getting 16 million. You're getting 16 million. Okay, so I think then we can finalize because we don't have any other transaction. So what we just need to do is now to get the one-offs. Is what we need to get the one-offs by adding all this. By adding all this. So let's add all this. Let's add all this. We get the final figure here. Yes, what are you getting? What are you getting is the total. You're getting a total of what? Yes, I'm getting a total of 136 million. 136 million, yes. So having that, then what we need to do is we compute the basic earnings per share by taking the patos, which we already have here, 201,600. We divide that with the one-offs, which is 136 million. 136 million. So whatever you get here will be shillings per share. Shillings per share. Shillings per share. So we have 201.6 divided by 136. 136. I'm getting a figure of 1.448. Yes, 1.482. 1.482. So that is the earnings per share. Shillings per what? Per share. And automatically insert a question what you can see the marks which were located were 6. So these are the items which are marked. That one, this, that, and that. How many items do we have? 1, 2, 3, 4, 5, 6, 7. So basically those are the items which are what? Are marked. And in most of the cases, you'll see for any correct entry you have, or for any correct item you get there, you get 1 mark. Or actually, you're required to have 6 items correctly. For every item you get what? 1 mark. 1 mark. So basically we are done with that one. So let's move to Roman 2 of that particular question. In Roman 2, what are we required to do? We are required to compute the restated earnings per share for the year which ended 31st of December 2022. The restated earnings per share for the previous year. Now, this restated earnings per share, or basically a company should compute, should adjust the earnings per share for the previous year in case during the current financial year there were some shares which were issued free of charge, because the shares which are issued during the current year, and basically here when we talk about the current year, we are talking of this year 2023. These shares, because we have some shares which were issued free of charge here or at nil consideration, those shares are assumed to have been issued at the start of the earlier reported period. Shares issued here free of charge, we assume they were issued at the start of 2022. So therefore, how do we compute these restated earnings per share for 2022? So we take the PATOS for the year 2022, this one, we divide that with one-off still for the previous year, 2022. And then now to this one-off, we add the bonus shares, which were issued in the year 2023. That is the general formula you use for restating the earnings per share for the previous year. Take the PATOS for the previous year, which is basically 2022. Divide that with the one-off for 2022, and then to the one-off you add what? The bonus shares issued during the current year. And actually, from what you have done here, we know that the profit for the year is the same with the PATOS. And that's why if you go back to the information we have in paragraph 1, the information we have in paragraph 1 is the last sentence. You can see we were given the profit after tax from continuing operations for 2023, which was 201.6, and for the year which ended 31st of December 2022, which is 97.2. So that profit after tax for 2022 is the same with the PATOS, because you have said profit after tax is the same with what? PATOS. I hope you can see also in this year. So therefore, the PATOS for 2022 is 97.2 million. 0.2 million. So we already have that figure there, the PATOS for 2022. So then we need to determine the one-offs for 2022. Now, as far as 2022 is concerned, there is no transaction we are given regarding the shares which were issued in 2022. In fact, also in 2022, we are not given the shares which were issued at the start and also at the end, as far as 2022 is concerned. Now, the only information we have as far as 2022 is concerned are the shares now which were issued at the end of 2022, because can you see these shares which were issued and fully paid at the start of 2023? These are the same with the shares which were issued and fully paid at the end of 2022. So that is the only information we have for 2022, the shares issued and fully paid at the end of 2022. And because there is no transaction we are given regarding the shares which were issued in the year 2022, then we assume that the shares which were outstanding for the whole year, which had been issued by the company during the entire year 2022, were the same as 43.2. So therefore, the one-off for 2022 will be 43.2. Will be 43.2. And then now to this, we are saying we check, or to this, we add the shares which were issued free of charge in the year 2023. And I think we have a number of them here. So for example, during this right issue, we have this bonus element. This bonus element, these are shares which were issued free of charge. So for 4.8, so we add them here, 4.8. And then we have this, these are not shares issued free of charge. These are not bonus shares. And then we have this bonus issue of what? Of 36 million. Of 36 million. Are these bonus shares? No. So basically, we only have those as the shares which were issued free of of charge. And that's how we compute the restated earnings per share. So, and I think having that now, let's get the final figure. Let's get the final figure. So we have what? So maybe you can get the total for the denominator 43.2 plus 4.8 plus 36, which will give us 84 million. So we have 97.2 divided by what? By what? This coming to, you have gotten 84. 84. Yes, 84. 84 divided by 84. So this will give us 1.157 shillings per what? Per share, shillings per share. So that's how we compute the adjusted, in other terms, the restated earnings per share for the previous year. And I think we are done equally with the Roman 2 of that particular question. So what we need to do is now we proceed to Roman number 3. To Roman number 3. Let's move to Roman number 3. To Roman number 3 of that particular question. In Roman 3, what are we required to do? We are required to calculate the diluted earnings per share for this company. And I think that is quite simple, because as per the information which you're given there, I can only see one potential ordinary share. So Roman number 3. The diluted earnings per share for the year which ended 31st of December 2023. Now you have to recall, I've explained like the 3 steps which you follow, the 3 steps which are followed in computing the diluted earnings per share. I've said for you to compute this, you need to follow 3 steps. Number 1, you need to go through the information which is provided, or the information given to you by the examiner. You do what? You first of all identify the potential ordinary shares which the company had the year under consideration. Here you'll be checking whether the company had issued any convertible security. Like in this case, recall this company had issued preference shares which are convertible. You also check whether the company had issued or had granted the employee stock option or stock warrant. As per the information which we have here, there is nowhere I have seen what stock options. So once you have identified the potential ordinary share or basically shares the company had in the year under consideration, number 2, we have said you compute the increase in earnings and also increase in number of shares on the assumption that those particular potential ordinary shares were converted into ordinary shares. And then step number 3, you then compute the diluted earnings per share using the formula which I gave you. Using the formula which I gave you. Using the formula which I gave you. So therefore, I want you to give me just 1 minute. 1 minute, please. Yes, so let's continue. So therefore, I've said that these are the 3 steps you need to follow. Number 1, you identify the potential ordinary shares of the company. Number 2, you compute the increase in earnings, increase in number of ordinary shares. And number 3, you compute the diluted earnings per what? Per share. So that is the first thing we need to, or basically those are the 3 steps. So let's start with step 1. We identify the potential ordinary share, or basically the shares which this company was having in the year 2023. And remember here, I've said that when checking for these potential ordinary share or shares, you'll be checking whether the company had granted the employees stock options, and equally whether the company had issued any convertible security. So I think from the information which we have here, we only have one potential ordinary share, because here There is nowhere we are told about the company having granted the employee stock options. So the only potential ordinary share which we have in this question is in paragraph 1, where we are told that in the first sentence, we are told the company had issued 12% convertible, redeemable, preference shares. So take into account these preferential shares are convertible. Any times you see the word convertible, it basically means that these are what? These are potential ordinary shares because they give the holders an option to do what? To convert them into ordinary shares. So as per this question, we don't have any other. We don't have any other. So therefore, the next thing we need to do is to proceed and we compute the increase in earnings, increase in number of what? Shares. So, and actually we say to compute that, we compute that on the assumption that these particular convertible preference shares were converted into ordinary shares during the current year. So, but before you compute these two items, there is some information which is very, very important, and we need to summarize it here. As far as these convertible preference shares are concerned, that's why you can see the examiner had given around 6 marks there, because there is some work which is involved here. So we know that the current financial year of this company started on 1st of January 2023, ended on 31st of December 2023. If you go back to the information we have at the paragraph 1, the information we have in paragraph 1, the first sentence, the preference shares issued by this company, we are told they were 12 million. And that 12 million, I hope you can see we don't have the word shillings before that. So 12 million, these are the number of convertible, redeemable preference shares. And you're told they had a par value of 10. So therefore, to get their total par value, you have to multiply that with 10. So meaning that at the start of the year, the 12% convertible preference shares issued by this company, they had a value of 120 million. The year number, 12 million times their par value, which will give us 120. And then, can we go to the addition information number 4? In the addition information number 4, we are told on 1st of October 2023 now, which is 3 months to the end of the year, 9 months from the start of the year, there were 12% convertible preference shares which were converted into ordinary shares on this date here. And the ones which were converted, they had a value of 80 million. So these ones were converted into ordinary shares. So meaning that the ones which were not converted, out of this preference shares which had been issued, the ones which were not converted, they had a value of 40 million. That information is very, very important, or you have to do that summary for you to be able to answer that part, that Roman 3. That's why you can see the question had around 6 marks. Yes. So what we need to do after that analysis is we proceed and we compute the two items, increase in earnings. And the increase in earnings, we are saying that this refers to the amount by which the profits attributable to ordinary shareholders would have increased with, on the assumption that this particular 12% convertible preference shares were converted into ordinary shares. And the general formula for computing this increase in earnings is this one. You determine the preference dividend, or the increase in earnings is always equal to the preference dividends paid. The preference dividends which were paid by the company. The preference dividends paid by the company. The preference dividends paid by what? By the company. And you also have to recall, we have said that this particular preference dividends paid by the company, I've said that these ones are classified as part of finance cost. Are classified as part of the finance what? Cost. So in other terms, these dividends, the dividend on these preference shares is treated just like interest on loan, the interest on what? Debentures. And therefore, this one is always deducted before tax. And the increase in earnings, therefore, here will be equal to the preference dividends which were paid, but net of tax. but net of what? Of tax, simply because you have said that this particular preference dividends on redeemable preference shares, they are classified as part of the finance what? Cost. So if they were converted into ordinary shares during the current year, the profits attributable to ordinary shareholders would have increased with what? With the interest which was paid, or the dividends which were paid, but net of tax. Net of what? A tax. So can we compute these preference dividends which were paid here? So first of all, we have to compute the dividends which were paid by the company for the first 9 months here. For the first 9 months. How do we compute that? We take the rate of dividends here, which is 12%, which is 12%. 12% times the preference dividends which had been issued for the first 9 months. In the first 9 months, the preference dividends which were issued had a value of how much? From our analysis here. In the first 9 months, the preference dividends issued had a value of how much? It had a value of how much? Who can tell us here? Had a value of how much? A value of how much? Who can tell us? Yes, they had this value. They had this value of 120. So we get 12% of 120 million. 120 million. And basically, this will only apply for the first 9 months. Will apply for the first 9 months. For the first 9 what? Months. And then in the last 3 months, the preference dividends which had been issued by this company, they had a value of 40, because on this date we know preference dividends which had a value of 80 million were converted. The ones which were not converted had a value of 40. So the dividends which were paid here was based on this preference shares. So we take 12 times 40 million, and then this we are saying will only apply for the last 3 months. The last 3 months. So this now will give us the total preference dividends which were paid by the company for the first 9 months, and for the last 3 months we add them, which will give us the preference dividends which were paid during that year. Which were paid during that year. So this will give us a figure of what now? This will give us a figure of what? This will give us a figure of what? This will give us a figure of what? Compute for me that figure here. Yes, I'm given a figure of what? I'm given 12 million. I'm given 12 million. 12 million. The total, I hope that is the total, which is 12 million. Is the total 12 million? Yes, 12 million. 12 million. 12 millions. 12 million, eh? Okay. So basically, these the preference dividends which were paid by the company during that year. And basically what that means is that if, for example, they were converted into ordinary shares, then this is the amount by which the profit attributable to ordinary shareholders would have increased with. Sasa? Yes. So then next, what do we need to do? We need to compute the increase in number of shares. We need to compute this with the increase in number of shares. So, sorry, we need to compute next the increase in number of ordinary shares, the increase in number of ordinary shares. So when talk about the increase in number of ordinary shares, basically, we are referring to the number of ordinary shares which could have been issued by the company on the assumption that these convertible preference shares were converted into ordinary shares. And actually, for us to do that, the first thing we need to have is the conversion rate. The conversion rate which we were provided with in paragraph 1. I hope you can remember that conversion rate. That conversion rate, I hope you can remember it. In paragraph 1, we are told that in paragraph 1, sentence 2, we are told the preference shares are convertible on the basis of 80 ordinary shares for every shillings 100. For every shillings 100 of preference shares. For every shillings 100 of the preference shares. Okay, someone is saying, Rangati is saying net of tax. In this case here, who can tell us, are we supposed to multiply this with tax? No. So this one, I've said it will apply to interest. You see, practically what we know is that if a company is paying dividends, a dividend tax allowable in taxation. When doing tax, do you allow dividends? Do you treat dividends as allowable expense from what you do in tax? Do you allow dividends or do you treat dividends as allowable expense? If a company has paid some dividends, is that allowable expense or not? So basically, we know that that is not allowable expense. That is not allowable expense. But now, if whatever was paid by the company here is interest, like interest on debentures and so on, that is when now we apply this one. So, but for dividends, this one will not be applicable. And that's why, for example, in that question, you can see even the examiner have not given you the interest rate. Sasa? Yes. Yes. So let's come back here and we compute the increase in number of ordinary shares. So first of all, equally, we need to deal with the first 9 months. So in the first 9 months, we know that the preference shares which had been issued had a value of 120 million. They had a value of 120 million. So what we need to do is to determine how many ordinary shares would have been issued, assuming those particular preference shares were converted into ordinary shares. This one will apply for the first 9 months. And then in the last 3 months, we know that the preference shares issued by the company, they had a value of 40 million. Equally, in this case, we need to determine how many ordinary shares would have been issued if those convertible preference shares were converted into ordinary shares. And equally, this one will apply for the last 3 months. So I want us to deal with the first 9 months. So what we need to do is cross multiply, then we divide. So in the first 9 months, we take 80 times 120 million divided by 100. And then you're saying that this will apply for the first 9 months. And then we go to the last 3 months. So we take 80. Now what we do, we ignore this one. So we take 80 times 40 million. 80 times 40 million divided by 100. And then we are saying that this will apply for the last 3 months. So basically, this now will give us the number of ordinary shares which could have been issued, assuming that our convertible preference shares were converted into ordinary shares during the current year. So let's work out this one. For the first 9 months, we have 80 times 120 million divided by 100 times 9 divided by 12. So which will give us 72 million. What about this one? We have 80 times 40 times 40 divided by 100 times 3 all over 12. So which is giving us 8 million. So, and this will give us a total of 80 million ordinary shares, or 80 million shares. So confirm. Yes, actually, I'm told by Magdalene that is 72 and 8. And that will give us now a total of what? A total of 80 million. So I think having that, then what we need to do is to finally compute what we refer to as what? we finally compute the diluted earnings per share, DEPS, diluted earnings per share. You have to remember the formula. The formula is that we take the PATOS. To the PATOS, we add increase in earnings. Increase in earnings, we divide that with 1/0 plus the increase in number of shares. Increase in number of what? Shares. That is a formula which we use to compute what? To compute the diluted earnings per share. To compute the diluted earnings per share. Yes. So let's do that. So in our case, we already have the PATOS and 1/0 used in the computation of basic earnings per share. The PATOS was how much? Was a figure of 200 and something. Was a figure of 201,600. 201,600. And then the 1/0. The 1/0 was it 136 million? Was it 136 million? Yes, 136 million. Yes, 136 million. And then now to this PATOS, we are saying we add the increase in earnings, which we have here. The increase in earnings, which is 12 million. And then to the 1/0, this one we add increase in number of shares, which we have here, 80 million. 80 million. And finally, what we need to do here is we get the diluted earnings per share. The diluted earnings per share. Diluted earnings per share. So what will be our diluted earnings per share here? We have 201.6 plus 12 divided that with 216. 216, is that the case? $216. Is that what you're getting? Yes, so that is what you're getting. So basically, what is marked in such a case are those figures there, the PATOS 1/0, and also the increase in earnings, increase in number of what? Of shares. So therefore, that's basically how we compute what is far as the diluted earnings per what? Per share. And actually, that is it. That what was required as far as that particular question for April 2023. 2024 question number 3A was required.